Hi everyone, I'm Laurel Marie Hickey. Welcome to What's Blank Got to Do with It. Today's What's Blank topic, 60-40. So what's 60-40 got to do with it? So when I say 60-40, I'm not talking about an age or a vintage. I'm talking about the composition of a balanced portfolio. In the industry, we refer to that as 60% equity, 40% bonds. So if we look at a year such as 2022, we had a dual bear market. So both US treasuries, bonds were down, and stocks were down, equities. So dual bear market. So in a year like 2022, having bonds in your portfolio, you might be wondering, did they really help or did they really hurt? Well, in 2022, there was really nowhere to hide, and we really do feel that it was a unique year. So why have bonds in your portfolio? Bonds offer superior risk-adjusted return over time. If you have bonds in your portfolio, there's a terrific ratio that we like to look at to see how you're really doing. It's called a Sharpe ratio. And so the higher Sharpe ratio that you have, the better risk-adjusted returns that you're having. So a Sharpe ratio measures return relative to risk. So in 2022, the investment landscape was unique. As we started the year, we had really low interest rates. And what happened during the year is we had inflationary pressures, we had supply chain disruption, we had geopolitical risk. There were so many factors in 2022, and the Fed reacted to this by increasing interest rates, by rising interest rates in order to slow the economy as fast as they possibly could. What this actually did with bonds is when interest rates go up, bond prices go down. It's an inverse relationship. So bonds in your portfolio, you would have also experienced a bear market in your bonds, meaning your bonds were down more than 20% at one point in the market. Same as equities were down more than 20% at one point in the market. Now they did recover slightly towards the end of the year, but the reality is it was a really tricky year for both asset classes in the market. So having looked to see where things are now, so pre-2022, if we look at the 10-year treasuries and if we look at the 30-year treasuries, they're half of what they are now. So we actually saw treasuries, the yields, pretty much double over the past year. With interest rates up and bond prices down, there is a lot of opportunity in the marketplace in this environment. So one, you're getting the yield, and two, you're able to buy bonds for the most part at a discount, which means they're trading below par. They're trading less than what they'll mature at. So you make money on the yield and you make money on the difference between the price you purchased it at and the price that it matures at if you bought it lower than that maturity price. If you have a 60-40 portfolio, 40% of your portfolio is in bonds, the recovery in those bonds should be quite good. So having a 60-40 portfolio has really been in vogue as far as the discussion going into 2023. Knowing what your Sharpe ratio is, knowing your personal Sharpe ratio, will tell you what excess return is above the risk-free rate of return for short-term treasuries. So you can tell if your money is working hard for you by having more bonds in your portfolio. So it's a super interesting ratio, and certainly having a conversation with your trusted advisor about that ratio and what your personal Sharpe ratio is would be very interesting. So yes, if you have a heavier weighted equity portfolio, more stocks in your portfolio, over time, you would have better returns. Equities have outperformed over the long run, and they have recovered 100% of the time. Having a 100% equity portfolio, though, you're subject to the real swings of the market volatility up and the market volatility down. So that particular risk tolerance is not for everyone. If you have heavier exposure to equities, yes, you will have a lower Sharpe ratio. So the more bonds, the more fixed income, the higher the Sharpe ratio. There really is a risk-reward trade-off with investing. So having exposure to different asset classes is super important. What is right for you really depends on your own unique personal story, your own unique risk tolerance, your ability to navigate through the emotions of risk as money goes up and money goes down in your portfolio. Knowing what a 60-40 balance is, or have an understanding that bonds do go up and down in value, is super important when you have a portfolio with a component of fixed income. I hope I've explained a little bit more about the 60-40. Until next time, I'm Laurel Marie Hickey of 3i Global Wealth of National Bank Financial.